Welcome back. You're watching First Trades, and let's look at what's happening in the F&O market. It's a quiet market as we speak, down just 30 points on the Nifty. But look at the Nifty futures. We're seeing some shorts getting added there, 0.5% shorts. The open interest is currently at 1.21, so that's something key to watch out for as we head towards the expiry. We're going to see a lot of addition coming into open interest there. Nifty Bank is another where we are seeing the index down nearly 0.2% and the open interest up 0.4. Some shorts are getting added there. Look at some of the stocks within the Nifty Bank, and we'll see that the shorts are getting added in ICICI Bank, SBI, Kotak, PNB. Surprisingly today, HDFC Bank is seeing some long build-up happening. There's a short covering happening in Bandhan and long position getting added in Axis. Call and put writing has been aggressive, especially the call writers have been aggressive at 24,600, and that's holding off as a resistance for the index. And if you look at the distribution, there's a support which is coming at 24,400, 24,500, and 24,600 holds as the resistance there. But then the range is very flat. 24,300 to 24,700 is something which we are seeing as a good range for the index at this point in time. Among the gainers, you have Hitachi up 9%, Paytm is up nearly 4%, Hero Moto is up 3% in today's trade, all adding some long positions. In the losers pack, you have Inox, Amber and Lupin all adding short positions there, all up, all down nearly 3%, over 3% in today's trade. Open interest gainers include stocks like Amber, where the open interest is up nearly 13.5%. GVT&D is seeing a short build-up, and Lupin is also post-earnings is seeing a short build-up with the open interest up 3% there. Among the losers, Kane Tech, there's unwind happening at Kane's Technologies. The stock is down after earnings. Delivery is seeing a short covering, and Oil India is seeing a short recovery there. Most active today is Titan 5000 August call, where the open interest is up nearly 13.5, over 13,000 contracts. Premium of up nearly 38 rupees. And the stock hovering just about the 50-50 mark at this point in time. The other stock which is active is SBI 1100 August put, where the open interest is up nearly 2.5 lakh contracts, and the stock hovering just below the 1100 mark at 1086 as we speak there. So that's what is happening. Is a flat market happening currently, with call writers being very aggressive at this point in time. Aisha?
Right, okay, that's the take coming in on what the market is looking like. But let me now welcome on board Vikas Gupta, MD Operations at PG Electroplast, to talk about how their quarterly performance has been. Vikas, great to have you on ET now. Starting off firstly, despite strong top-line growth, the EBITDA margin has declined for you. What led to that, and what specific levers will help you achieve the 8% operating margin target that you had for the fiscal end?
Please understand, right now the commodity inflation is very high, and we have been able to pass on some part of that BOM cost increase to our clients, and some is still under discussion. We feel that we will be able to pass on the complete impact of the increase in the cost of the bill of material to our clients in the coming quarters. And we are already in discussion with them. So we are hopeful for maintaining that 8% margin in the coming quarters.
Can you also give us a sense of, you expect a growth of nearly 20% plus ahead of industry growth. What structural advantages gives you that confidence that you can consistently outperform the industry?
So we are already working with the clients, and it is based on the product pipeline that we have and the interactions that we have with our customers. We are confident that we will be able to grow at an industry-leading growth level, and I think the teams are working on that. We are already increasing the wallet share with the existing clients. We have already onboarded quite few new clients also in the past quarter. And so based on that working, we are confident that we should be able to grow at a decent pace going forward.
Right. I want to talk about the major highlights of the quarter gone by and what, according to you, was the growth driver.
So it was kind of a landmark quarter for PG Electroplast. We did cross the revenue of 2,000 crores in a single quarter. That was the first for this company. Then we achieved our highest ever sales in air conditioners and in wash machines in this quarter. So this quarter has been quite remarkable in the terms of performance in our these two broad categories. And overall revenue also grew and crossed 2,000 crores, which is kind of a landmark for us.
Because you're going to see several new facilities coming on stream this year. How quickly you expect these plants to reach optimal utilization, and when can we see a meaningful revenue contribution?
So we are coming with a brand new greenfield facility for refrigerators in City City near Chennai. And we expect that we should be able to start the commercial productions in the Q4 of FY27. We are hoping that it should start contributing meaningfully to our revenue and our bottom line for FY28. And we are already in touch with the clients. We already have some soft commitments. So we are very bullish on that refrigerator project. We have also come up with a new, I would say, best-in-class manufacturing plant for the washing machines in Greater Noida, where we have further increased our capacities. That has already started the production, and we are hopeful that we should be able to have a adequate loading and in the coming quarters. We are already experiencing a robust growth in our washing machine business. So we are very confident that we should be able to engage that capacity very soon. We have also come up with a new plastic molding and tool room plant in the Salarpur in state of Rajasthan. That is also started the commercial production. So that should also start contributing from the next quarter. And FY28 should be a better year for that plant. So hopefully we feel that these three plants will start contributing in an effective way in the FY28.
Right. But tell me, once the compressor business scales up, what should investors expect in terms of profitability versus your existing EMS business? Could it structurally improve your consolidated margins?
So compressor is again a landmark project for us that we initiated 2-3 quarters back. And we are hopeful that we should be able to start the production in our compressor facility by again Q4 of FY27. We are seeing a very keen interest from some of the clients, and we are hopeful that we should be able to engage this capacity very rapidly. We are coming with a 2 million capacity right now, and the land and building that we have created is capable of handling a capacity of almost 7 to 8 million. So in the phase 1, we are putting up 2 million capacity, and it should most of that, I would say the major part of that 2 million output will be used for our captive consumption. So it may not add to the revenue side, but definitely will be margin accretive. It is very difficult to give me some kind of accurate number to that, how much impact on that margin it will have. But our teams are working on that, and we are hopeful that it should definitely help us in improving our margins in air conditioner business.
Because as you diversify beyond room ACs, how do you see the revenue mix evolving over the next 2 to 3 years? Which businesses have the biggest potential to become meaningful growth engines for you?
So currently, the air conditioners contribute almost around 60 to 65% of our revenue. And I think going forward, AC will still remain a significant part of the revenue for our company. We are also we have got into refrigerators, and we are growing our business in electronics division. We are growing our business in washing machine business. So we are anticipating that we should be able to bring down the dependence on air conditioners as a revenue stream in our company from 65%, 60% to 50% in next 2 to 3 years.
Right. And now that the business has returned to a net cash positive position and the major capex cycle is now nearing completion, how should investors think about free cash flow generation and, of course, your return ratios as well over the medium term?
Our teams are working on this aspect only. Now, this year also, current year, we have a capex guidance of almost around 400 crores internally. We are working on that. Largely, that capex will go into the completion of ongoing projects of our compressor and refrigerators. Beyond that, we do not see a major capex cycle for the FY28. But definitely, as the revenue improves, as the margin improves, the cash flow position should improve. We do not have the accurate number right now, but the teams are working on that to create the adequate free cash flows to fund the future expansions.
Guys, thank you very much for giving us this perspective after the earnings. Thanks for joining us today. But moving on to Greenlam Industries, Ashok Sharma, CFO Greenlam, joins us. Ashok, give us a sense of the kind of headwinds that you've seen this quarter. You had crude derivatives going up, logistics costs going up. How did you manage all those costs?
Good morning. Thanks for having me on this show. As you rightly said, the starting of this or beginning of this quarter was very challenging in terms of when the raw material prices were going up, the export becoming the challenges in terms of freights and the availability of container. So in this, what we did, the raw material impact were passed down into the market, and the price was quite fluctuating. So we passed down 2 times the impact to the market and reduced 1 time also when the prices were a little bit softened in terms of that. In terms of exports, we did pass on the additional export or the freight hike to the market to some extent, and some extent borne by the company. But I'll say that so it's quite challenging towards the end of quarter. The availability of container was a huge challenge in terms of that is postponed close to our 25-30 crore of export, which has been pushed to next quarter.
And Ashok, wanted to understand if it's impacting the volumes as well at all, this freight hike cost which you're having to pass off?
Yeah, it is. It is. In terms of that, even though we got the orders, but we could not able to ship it, so which means the revenue in this quarter is lower. And unless until these goods reaches to the customer, so the new flow of orders will get impacted to some extent in terms of that. But we are hopeful that this is more of a short term in nature, and we should be able to quickly come back to the growth phase.
Do you see further rate hike or price hikes coming in the second quarter? And is this market able to absorb this kind of hike as well?
No, we don't foresee this the further hikes in the current quarter. In fact, the raw material prices were corrected towards the beginning of the June. Of course, some bit of movement again seen toward the beginning of the July when the war has again started. But prices has cooled down post that also. We don't foresee the prices to go up from here in terms of that.
Also, give us a sense of the kind of margin levers that you have, and you're looking at 18+% of top line growth in FY27. Is that intact? And do you see a growth to be pushed to the second half of the year?
In fact, if you see in the first quarter also, we did grow at 18.2%, and we believe that we will be able to continue the momentum. Apart from the laminate, which is growing a steady state, of course, because of export, there is some challenge in the quarter one, but going forward, it should be good. But the new segment like chipboard and plywood, they are doing good. In fact, in the chipboard for the first quarter, we turned into a EBITDA positive, and we are hopeful from here we will be able to continue the momentum, and that can bring more revenue as well as to the bottom line also.
How did you manage your working capital cycle in this entire scenario? Have you been able to bring in more efficiencies in the working capital?
Working capital, in fact, it is a bit stretched at this moment because, as I said, that we have produced but could not able to ship in terms of that, and some of the payments are until the material reaches, then the payment get delayed. So I think working capital is a bit stretched. Even after that, we could able to improve in comparison to previous year, but we believe that situation should improve in the Q2.
So if I could just go back to chip board as well, wanted to understand when is it that we should expect some improvement in margins for this segment?
In fact, if you see the chipboard, the growth is happening on a quarter-on-quarter basis. In the very first year, in the 5 quarters, we reach up to 61% of capacity utilization, and this is the first quarter in which we have done the EBITDA positive within 4-5 quarters. And we believe from here the further growth will be there, and the margin will improve from here.
Ashok, you are penciling in a growth of over 18%. Laminate expected to grow 10 to 12% top line. How do you manage the margins in this current scenario? Do you have enough inventories in place? As you said, some of the raw material prices have eased off towards in June. Do you see what is the kind of outlook you have on those prices?
So we believe that the raw material prices from here, there is not much upside which we see from here. And in the past also, whenever there is a huge movement in the raw material prices, that has passed into the market by us and by all the major players. And that is accepted by the market because at the fair level, whenever there is increase only, that is passed on into the market. So we believe we will be able to maintain the margin for the laminate segment since the raw material price hike has been passed on into the market.
Right. Okay, Ashok, great to have you today on the show. Thank you so much for your time.
Thank you. Thank you.
Okay, that's the word coming in from Greenlam talking about how their numbers have been. But the other group of stocks which has been very active has got its link to an anticipated index rejig as well. Let's try and address that. And we will, of course, get more details in terms of what the possible rejig of the Nifty 50 is going to look like, and BSE is seen replacing Wipro from what we understand and what brokerage notes have been saying about it. Actually, let's take a very quick break. We'll address all these newsmakers in just a bit. Well, the Nifty could see a rejig today, with Nuvama expecting BSE to replace Wipro under the current methodology. Let me quickly take it across to Ashesha and find out what this move could indicate in terms of inflows and outflows.
Well, yes, the Nuvama Alternative and Quantitative Research has come out with a report on the likely inclusions and exclusions from indices in the September rejig. And first up, let's talk about Nifty, where they're expecting BSE to, in fact, replace Wipro, where they are penciling in about $741 million of inflow for BSE and about $246 million of outflow for Wipro on its likely exit. Nuvama says that if Nifty Indices Committee makes any methodology changes today, the meeting is likely to happen today, then they also believe that TVS Motor could be a potential contender to actually replace Wipro. So TVS Motor, BSE are the two contenders that they've spoken about. As far as the Nifty Next 50 index is concerned, Wipro could get added, and this could see an inflow of about $95 million. Vedanta Aluminium, Hitachi Energy, Idea, Polycab and BHEL are a couple of other likely inclusions, with Indian Hotels, REC, United Spirits, Shree Cement, Lodha and Mascot Dock likely to get excluded. So yes, several changes that are expected to happen in the Nifty rejig in the month of September this year.
Right, okay, Ashesha, we'll leave it at that. Interesting names being worked upon there. But on that note, we're going to wind it up right here on this edition of The Market in First Trades.
Hi there, good morning. You're watching Midcap Masala on ET Now. This is the show where we're going
be diving deep in the broader end of the company, of the market. And speaking of which, from the FMCG space, Godrej Consumer Products has come out with an inline set of numbers. Let's interact with the management to try and understand what the growth outlook is going ahead. We've got Mr. Aarti Pharma, the CFO of GCPL, joining us on the show. Mr. Balmari, hi, good morning. And quarter one has been a good quarter for you overall, Mr. Malbari. Let's start by talking about your commodity costs. While costs have started to ease, some categories are still seeing inflation. Can you quantify the price hikes taken across categories, and do you expect to take further price hikes this year, or do you believe the worst of the pricing action is now behind us?
Quarter one has been a very good quarter for us, both in terms of delivering a very, very strong top line as well as delivering a strong double-digit bottom line. It has been broad-based across categories, across geographies. And as you know, it has been a volatile time in terms of Q1, in terms of commodities. Both it's been elevated commodity costs and volatile commodity costs, and it's made it difficult to kind of navigate the quarter, both in terms of pricing and in terms of profit. Having said that, and the impact was if we have to kind of specifically talk of the India business, around close to 600 bits, yeah, so around close to 150 crores is the impact in terms of quarter one on costs. We could actually mitigate most of the cost increases through a combination of savings, cost optimizations, pricing, and mix actions. So we were able to deliver the P&L shape which we wanted to. The price increases for the portfolio for quarter one has been broadly around 5%. I do believe, I think the worst is behind us. So I think as we go through, I'm hoping that commodities kind of settle down, and hopefully we wouldn't need to kind of take significant price increases.
Okay, so that's the outlook on price hikes, not looking at more in the near future, at least not hoping for. And what has the response to these price hikes been on ground? What is the kind of absorption that you are seeing? And has there been any impact on demand at all? Because you have mentioned that this quarter has seen a challenging operating environment for you, at least for the first half.
A reasonably large price increase which we have to take. Having said that, it's something which has impacted the entire industry. It's been different in certain categories, but it's impacted the entire industry in which the entire industry has moved up in terms of pricing table. So to that extent, I would say there has been no relative kind of issue in terms of taking up prices. When I talked about difficult operating conditions, it is because of the volatility and availability. In some places, there was an issue in terms of getting the commodities connected. There was an issue in terms of fill rates, etc. But most of the things have kind of stabilized as we speak.
Okay, and Mr. Malbari, since you are saying that it's looking to be stable now, do you expect gross margins to improve as input costs soften, or is it too early to make that call?
It's still too early to kind of expect gross margin improvements, because all said and done, these reductions in terms of costs happen with a lag. Even as we speak now, there is some bit of a volatility from week to week basis, depending on the global development. Costs do keep moving up and down. So I think we'll have to wait for a few more months for the situation to stabilize before gross margins improve. But yeah, definitely margins will kind of come back.
Okay, and Mr. Malbari, your India volume growth has come in slightly shy of the street estimate. Are you on track for high single-digit underlying volume growth in India for FY27, since quarter one for you has come in at 7%?
Yeah, we are on track. I think overall we're quite happy with the shape of high single-digit volume growth in India, and we started quarter one with that. At a consolidated level, we are very close to touching double-digit. Overall consolidated volume growth was at 9%. So it's been a solid volume-backed revenue growth. And we should be able to deliver the expectations.
Okay, that sounds optimistic. And let's talk about your soaps business that has seen a strong recovery in volume this quarter. Can you help me with a number on this volume growth, any indication? And do you believe this recovery is sustainable ahead?
Yeah, so we don't go into category-wise volume growth, but yes, soap business is kind of coming back in terms of growth. And I think sequentially the situation should only improve.
Okay, and you've also entered categories like toilet cleaners and face wash, and this quarter you forayed into the liquid dishwash category too with Godrej Riz. How have these newer launches performed so far, and by when do you expect them to become meaningful contributors to your top line?
I think currently I would say most of our new launches have become meaningful contributors. We've classified some of these portfolios which are high growth portfolios. The salience of that has actually moved to around 17% this quarter, so it's reasonably meaningful. It'll only keep going up. We do anticipate the salience will get to 20% by the end of this year. There have been a few more incubations which we've done, which, as you mentioned, toilet cleaner is something which we did a couple of quarters back. It has met all its action standards. Currently, we've expanded it to nationally. It's been received very, very well by consumers. There are multiple other products which are in the pipeline. We have introduced RITs in the market as we speak. This is a dishwash liquid product. Again, holds a huge potential in a fairly fast-growing market. So we are quite confident about the total impact which our growth portfolio will have going forward.
Okay, sounding good. And Mr. Malbari, since your Q1 revenue growth is tracking well ahead of your original estimates, are you comfortably on track for double-digit revenue growth for FY27? And if, I'm trying to gauge a number, could this be in mid-teens?
Yeah, so I think we started the year well. We definitely have had a very, very strong Q1 in terms of revenue growth. So we do believe that we are on track and we should be able to kind of beat some of the estimates for FY27.
Okay, that's interesting. You say that you're looking at exceeding some of those FY27 internal estimates that you've set. So that sounds really optimistic as well. Now, speaking of your international segments, Indonesia, for one, has returned to double-digit growth after a challenging period. Do you believe this turnaround is now complete, or is there still more room for improvement for Indonesia?
No, we had mentioned last year that the business is now stabilizing and will kind of move to growth. So in line with our guidance, the business has kind of delivered a very strong growth. I think there is a benefit in terms of seasonality, etc., which we've got in Q1. But we should be able to kind of sustain a high single-digit volume growth going forward.
Okay, high single-digit volume growth for Indonesia. We're going to be watching out for that. Lastly, Mr. Malbari, when it comes to your segments, home care has consistently outperformed in recent quarters, while personal care is showing signs of recovery. Which category do you believe will be the biggest growth driver for GCPL over the next few quarters?
Yeah, I think it will be both categories, home care and personal care, because both of them have a huge growth potential. We have introduced products in both of these categories. There are innovations which are there, and we continue to support both. So, yeah, I think it's going to be more broad-based growth across our subcategories.
Okay, sounding really good. On that note, Mr. Malbari, thank you so much. Congratulations on a good quarter that you've seen in the first quarter, and hope to interact with you very soon ahead as well. So viewers, that was the management of Godrej Consumer Products joining us on the show to break down their Q1 numbers. Largely inline set of numbers, the management is confident of not only meeting their FY27 internal targets that they've set for themselves, but on some fronts exceeding them as well. They've taken a 5% price hike across the portfolio, and they believe that the worst of the pricing action is behind them. So that sums up that conversation. But I also have Ashesha, who's joined me on the show to give us a deeper dive on the broader end of the market right now. Ashesha, take us to some of the top buzzers.
Well, yes, while it is absolutely quiet on the index level, several individual stocks, especially from the mid-cap segment, are buzzing in trade. Let's put the spotlight on some of them. And first up, let's put the spotlight on Sky Gold. All that shines is gold for Sky Gold today, as the stock sees sparkling gains on stellar first quarter numbers that the company reported. The company has reported a 78% jump in revenue on a year-on-year basis to come in at 2,013 crore and more than doubling its profit to about 103 crore. It has also raised its FY27 revenue guidance to 8,100 crores from 7,500 earlier, and this is exactly why the stock is up more than 9% in trade today.
Very strong gains for Sky Gold, and the other big buzzer today is Hitachi Energy India. That too is seeing very strong gains after robust Q1 earnings. The stock too is up more than 9%, with profit more than doubling to 294 crores and revenue jumping almost 70% on a year-on-year basis, beating street estimates. Brokerage houses like ICICI Securities and Axis Capital have upgraded their rating on the stock to a buy and add respectively, while also hiking the target price. And shifting focus to the real estate sector then, Raymond Realty is under massive pressure today after first quarter profit fell by 19% on a year-on-year basis, despite strong revenue growth that the company reported as expenses surged sharply. However, pre-sales jumped over 2 times, with the company now retaining its FY27 margin guidance. The stock, however, is down nearly 8% in trade today. But shifting focus to Hindalco Industries then, that counter reported its numbers on Friday, with Novelis reporting its numbers 2 days before that. Novelis reported very strong set of numbers for the quarter gone by, and standalone India operations numbers, especially EBITDA and margins, were much ahead of what the street was working with. The stock was shining bright on Friday. But to discuss these numbers in greater detail, we are now joined by the Managing Director of Hindalco Industries, Mr. Satish Pai, who is now joining us. Mr. Pai, thank you so much for taking your time out, and let's start by talking about India operations, where if we compare the numbers on a sequential basis, it looked soft, but as compared to estimates, and even when we compare on a year-on-year basis, it was a strong growth of 26% YOY. If you can take us through what transpired for India operations in the first quarter of FY27.
So for us, this quarter on the India business has been an all-time record EBITDA and PAT. And I think that the basis of this is that the aluminium prices have been very strong. Our operations have been very steady and consistent. And I think that our costs, we have been able to manage the cost as well, because many of the energy costs and all have been spiking. But I think that we managed to keep the costs at about 4% increase in rupee terms. So on a dollar terms, it was flat. So the fall through was very good. So I think that, good commodity prices, strong operations, and good cost control.
Okay, higher commodity prices and cost control aided numbers in the quarter gone by. But much of the revenue growth, as you rightly pointed out, was aided by higher aluminium prices on the London Metal Exchange. And that was a major factor of West Asia crisis as well. Where do you think aluminium prices are headed in the near term, and do you expect them to remain firm?
So I think that we see aluminium prices for the remainder of the year staying very firm. I think that currently they are at 3,200. I think the range will be somewhere between 3,200 and 3,400 for the rest of the year. Largely because this calendar year, aluminium will be in a $1 million deficit. Inventories are low because the Middle East capacities have still not come back into the market.
Okay, so 3,200 to 3,400, that's the range where you expect aluminium prices to be for the rest of this year. But let's also talk about downstream EBITDA per ton, which came in at about $303, which was an increase of 15% on a YOY basis. Is this number sustainable, or were there any one-offs which are likely reversible in the next few quarters?
No, there was no one-offs. I think that because of the aluminium prices, we could maintain a high pricing on the downstream level as well. I think that, downstream volumes are going to pick up further in Q2, Q3, Q4. So I think that the overall profitability and the volumes on the downstream side, you're going to see an increase in the coming quarters.
Okay, so downstream profitability and EBITDA is likely to increase, and there were no one-offs. That's the word coming in. Mr. Pai, let's also talk about costs for both India as well as Novelis operations. Where do you see them headed going forward?
I think on the India business, we are going to see some more costs going up in Q2. It's a monsoon quarter. Generally, the coal costs go up. So I think you're going to see another 3 to 4% inflation in costs in Q2 over Q1. On the Novelis side, I think, we have a very active cost reduction program going on. We have already reached a run rate of $225 million on an annualized run rate. So I think on the international side, we are extremely conscious to keep the costs down, and we are actually having good results in that.
And while we are talking about Novelis, let's also talk about Bay Millet, which is now nearing completion. And we have spoken about this time and again with respect to the timing of its IPO, which has been on hold for the last 1 year. When will Novelis IPO, which has now been stalled for more than a year now, see the light of the day? Is it likely in the coming few months?
Our only focus in Novelis right now is to get Bay Minette commissioned and then ramped up. and the ramp up will take another 18 to 24 months. So in the short term, plans for Novelis is complete Bay Minette, ramp it up, and then deliver the balance sheet to get the net debt of the EBITDA of Novelis back to 2.5.
So IPO perhaps some months away, that's the word coming in. But let's also talk about EBITDA per ton for Novelis, which came in at about $563 per ton, which was an increase of about 4% on a sequential basis. And medium-term normalized EBITDA guidance of 600 has been maintained. What will EBITDA per ton be for the remaining 3 quarters of FY27?
So I think, it's important to point out that if you take out some of the insurance recoveries, the underlying Novelis EBITDA per ton was $525 per ton. So I think we are fairly confident for the remaining 3 quarters we'll be able to maintain it at those levels.
And what about consolidated net debt, Mr. Pai? It came in at about 77,500 crores, and net debt to EBITDA at a consolidated level has risen. And for Novelis too, it came in at about 4.5 times, which is at the upper end of your earlier guidance of about 4.1 to 4.5 times. Has debt now completely peaked out with Bay Minette coming to an end? And what will the deleveraging roadmap look like for the next 2 months?
So the consolidated net debt to EBITDA is 1.95. Novelis net debt to EBITDA was at 4.47. We think this is the peak. It's going to be probably at the same levels in Q2. And we have committed that in Q4, Novelis's net debt to EBITDA will come below 4.
Okay, Novelis net debt to EBITDA below 4 by the end of next quarter. And let's also talk about tariff-related costs. Are that a concern for Novelis at this point in time?
So I think that, this quarter we had about 70 million tariff impact because we still had to import a lot of metal as Oswego is not fully ramped up. So quarter 2, Oswego will fully ramp up, and then most of our US supplies will come from US based plants, and hence the tariff impact should get minimized.
Okay, Mr. Pai, thank you so much for taking your time out and joining us here on ET Now, and congratulations once again on a very strong set of numbers that you reported. The stock, of course, was not doing much today, but it was in focus on Friday and even before that when Novelis reported its numbers. But shifting focus to other stocks that are in focus today, and let's put the spotlight on Paytm then. The stock is up 4% in trade after Bernstein retained its outperform rating and raised its target price to 2,200 from 1,500 earlier. That's a massive 700-point increase in their target price. Bernstein has moved UPI merchant discount rate, or MDR as we call it, from an optionality into its base case, with benefits expected from FY28, which is why the stock is up 5% in trade. Mithali is now joining us with the highlights of this report.
Right, so Paytm is in focus, and as it gains a sharp confidence coming in from Bernstein, as the brokerage has given a sharp spike in its target price for the stock. Now, Bernstein has retained its outperform rating for the stock, but have raised their target price from the earlier of 1,500 rupees to now 2,200 rupees, citing an upside potential of nearly 53% from the last closing price. The key trigger is the UPI monetization, and Bernstein now moves the possibility of merchant discount rate, or what is called the MDR on UPI, from an optional upside scenario into now its base case starting FY 2028. Importantly, consumers are expected to continue using the UPI for free, with the charge largely to be borne by the merchants. Bernstein estimates that around 55% of UPI transaction value could be eligible for MDR in FY28, rising to 60% by FY 2030. And that matters because transactions above 2,000 rupees already account for more than 2/3 of the total UPI transaction in terms of values. So for Paytm, the impact could be meaningful, 3 to 4 basis points of incremental net payment margins, translating into around 22 billion rupees of additional EBITDA by FY 2030 as per the estimates cited by Bernstein. The broader growth story also remains quite strong, with GMV projected to rise from nearly 31 trillion rupees in FY 27 to reaching to 56.6 trillion rupees by FY 30, alongside improving contribution margins for the company. So overall, a very bullish stance coming in from Bernstein, and hence we can see that the stock has been in focus.
Well, yes, the stock is now up 5% on the back of that that Bernstein report where they've hiked the target price to 2,200. The stock currently trading at about 1,500 odd levels. But shifting focus to the pharma sector then, and Aarti Pharma is in focus. The stock is up as much as 15% after the company reported strong set of numbers for the first quarter. It has approved 150 crore of capex for about 405 kiloliters of additional capacity to serve intermediate and CDMO customers. Meryl is now joining us with the highlights and why the stock is locked in upper circuit of 20% today. Meryl.
Right, so Aarti Pharma is firmly in focus today after the company posted a very strong set of first quarter numbers, and they've also announced a bit of a management rejig which is in highlight. So let's take a look at the numbers first. The revenue for the quarter came in roughly up 40% on a year-on-year basis. EBITDA jumped nearly 50%, while margins also saw an expansion of up to 180 basis points. Profit for the year, that saw an uptick of 63% on a year-on-year basis, coming in at 76 crores. What's more important is that the company's joint venture, Ganesh Polychem, has also seen a turnaround in terms of profitability. The JV, which reported a loss of 1.8 crores last year, has now swung to profit of 7.4 crores. And there's even more on the growth front for the company. They've approved a 150 crore capex for a 405 kiloliter capacity addition, which is going to be focused towards the company's CDMO clients. Now, the investment is also going to be funded through a mix of internal accruals as well as borrowings. But the investors are also tracking a change in management, which has been just announced. Rashesh C. Godrej will be taking over as the company's managing director, while Hetal Gogri-Gala will be moving into more of an executive director role. So these are all of the highlights which are keeping the stock firmly in focus today. It's hit upper circuit at up 20% in today's trade.
Meryl, thanks so much for joining us with all those details. The stock is up 20%, but that's all the time we have in this edition of the show. Thanks so much for tuning in. Buy now, sell now will come up next.